Hey traders, Raghee here. Welcome to Charts and Coffee for July 20th. Good to see you all. So it's Tuesday. Yesterday in the free video, I talked about the levels and what to watch for if this is indeed a turnaround Tuesday. It's just one of those things that traders say. If there's a Monday sell-off, what are the different intraday type seasonals we could see? And there are intraday seasonals. There are rhythms to the market. I don't know that this is actually a perfect example of if for those of you that are fans of intraday seasonals, I don't know that this is a perfect example of one, but I am very interested in seeing how we're going to respond to yesterday's sell-off. Now, if you checked out the free video, you also know that the sell-off in the S&P was nearly 2 times the typical historical volatility for a single session. And the NASDAQ, while it looked like the market's really in meltdown mode, really traded only the average amount of price movement for the session. So I think there's a lot of interesting things to take away from what continues to be the relative outperformance leader in terms of the broader markets, and that is certainly still tech, and then healthcare and a number of other sectors within these indices. So with that in mind, let's make a quick pit stop at the calendar, because if there's going to be a sudden shift in psychology, it'll likely come from what's happening on the economic calendar. Now, after last week, where we were just inundated with so many FOMC events, this week seems, by comparison, pretty sedate. And we have very little, major data. Building permits, housing starts happened 30 minutes ago. Really did not seem to do much to the broader averages. And you can look at so if you want to know how a particular data point affects the market, at 8:30 a.m. Eastern, or if you're looking after the fact, go look at the way the Dow, the NASDAQ, the S&P reacted to that data release. You'll get a pretty good idea of the psychology. So very little. Now, remember to also look ahead. In other words, if we know that in a day or two, there's going to be a major economic event, the only thing that's kind of landing on my radar as far as something the market might be looking ahead to, and this would be more in the central bank area, would be we've got the ECB on Thursday. And when any of the G7 or even G8 countries have ECB meetings, remember, all these major central banks have pretty much the same policy right now. Only the US central bank has a dual mandate of not just inflation like all the other central banks do, but also jobs, employment. So there's a dual mandate for the FOMC and really just primarily an inflation mandate for the other countries. So if you're thinking about what other countries are suggesting, there's sort of this effect where, all right, the ECB is citing certain headwinds, or if the ECB is taking a certain type of track in terms of their current monetary policy, we'll probably see a lot of that echo through the other countries. So not a whole heck of a lot to take away from there. Yeah, let's just pretty much say that everyone's going to remain pretty darn accommodative. All right, so that's what I've got to kick off the morning. And then I also want to, again, remind everybody that for the most part, we still see the markets dominated with bullish directional bias, which means one of the things that I love to remind myself of is, and I think this is really important, because sometimes there's sort of this adversarial type of analysis that sort of takes place where usually most misunderstandings for analysis will take place at the time frame or time horizon level, or they'll take place in, for example, if you are short the indices right now, taking advantage of some sort of retracement move, cool, right? It doesn't mean that the buy the dip crowd isn't rooting for you. I've been saying for a long time, sometimes the most bullish thing you can be is a near-term bear. So that means that in order to get to the pullback level that I capitalized on yesterday, whether that be NASDAQ or S&P, whether that be some of the relative outperforming sectors, we do need the weakness. So, I think one of the worst things we can do, psychologically speaking, is two mindsets. One, that this is always a very adversarial situation. Yes, for every buyer, there's a seller, but really, in terms of relative size, we're all pretty insignificant in this giant place called the market. No market taught me that more than the Forex market. Multi-trillion dollars. Nobody's caring about the 10 or 20 lots that I might be trading of the Euro US, right? It's just not even a blip on the radar. It's not even a drop in that ocean, quite literally. So that's number one. And number two is the market's not out to get you. If you were a bull and you experienced yesterday and kind of left a bad taste in your mouth, ask yourself, was I buying near highs in a parabolic market? And might it behoove me then to just acknowledge that dips happen, and how can I position myself to either absorb that move or capitalize on it? All right. So just a little bit of broader sort of tactical and psychological approach to what we're seeing. And again, don't ever feel the markets are out to get you. Frankly, that's a little bit grandiose, because frankly, and I can tell you after 30 plus years, the markets don't even know individually that I'm even there. I kind of liken it to those of you that surf. You think the ocean knows we're surfing a particular wave? Not even close. It's going to do what it's going to do. So, you don't have to feel like that's what you're up against. Any expectations for the NQ today? PH, I think I outlined it pretty thoroughly in the free video. So just to sort of reiterate that, this is an uptrend. The move lower, I was rooting for it. Yay, bears. Thank you very much. I hope you guys made money on the way down. Now I want to buy that dip and see a retracement of that move to the downside. I'm not saying we're going to see higher highs through or new highs, I should say, through the recent wicks we have up there, but I am looking for the market to move higher. Could I be wrong? Absolutely. Am I going to be bullish? I frankly got no choice, and that's by design. Take a look at the indicators at the bottom of the screen, the double greens. The double greens are saying, Rog, just go with the flow, right? This is what the flow is. Pullbacks are going to happen. How do you view a pullback? As an opportunity. That's what trend traders and dip buyers and, all that, I think the trend following mindset has to be that. But the trend following mindset also has to accept that there will be that one last dip that we buy before the market does go into distribution or even eventually turns into a downtrend. We have to accept that. But if we trade in fear of that, we're not going to be able to capitalize on the path of least resistance. I think what prevents a lot of trend followers, dip buyers from succeeding at that approach is that they're always afraid of, well, what if this is the reversal? So what? Right? The longer you wait to capitalize on the pullbacks, the retracements, it's almost Murphy's Law, right? It's inevitable that suddenly you'll take the second or third dip and now the market transitions. And then the brain goes, see, it doesn't work. But it doesn't say, oh, but it worked the second time and the first time, maybe even the third time. And it was the fifth time that when, individually somebody might have taken advantage of it, it finally stopped. So keep those in mind. It's so easy to get consumed by our biases. For days like today, being that we are double green, but below the anchored VWAPs on the directional bias, am I still to the long side on the NQ? So there's two things here. Two things for sure. James, hey there. So when I start day trading in 20 minutes, there's two things I'm going to look at. One, the 10-day anchors, which is going to be sitting still on the 9th. So I'm still going to be looking at that on the 9th. So yes, I'm below the VWAPs, and the handful of things that I look at to calculate on the daily on the NQ specifically might say that we're slightly bearish or whatnot. But please don't forget the JT multi. Please don't forget the structure of the trend. So you might say, Rog, our one-day gauge or our VWAP, our patterns, they're indicating neutral to bearish. And that is true. But the larger structure of the market via the 8, 13, 21, and 34, which is what is the JT multi, what it's measuring, that's still very bullish. Now, the S&P is going to be trickier, right? The S&P is going to be trickier. Somebody asked me via email, well, Rog, we know you're bullish, you want to buy the dip, but was there anywhere that there was a short in front of this sell-off yesterday. Only one place, the Dow. Only one place. And why do I say that? Let the structure dictate what you're going to do. See how the Dow's been in a lower row there, yellow, 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 yellow? That means the market's been in distribution. That means that it's a legit conversation to take a look at Darvis resistance levels to the top of the range, and look at a slow stochastic, or look at a ready aim fire and say, is this nearing an overbought resistance zone? I would say it's still a little aggressive because the trend that was up, but it's not invalid. And so in my estimation, when people ask me, okay, Rog, we get it, you're bullish, but was there anywhere that made sense to be short? And there was one and only one, and that was the Dow. That was the Dow. XLI, IYT, so your industrials and transports have already been weak. And as the Dow goes to the upper end of the range, I'm not going to pick a top on the S&P. I'm not going to pick a top on the NASDAQ. My tools, my rules forbid me to do that. But the Dow was a one place that said, yeah, you can take a distribution top of the range fade short. So I hope that makes sense. I got a lot of those questions yesterday. And the other question is, well, Rog, would you take it? It's not typically what I like to do. I'd rather follow the trend. But the more that I can be transparent and show you all the setups, hopefully it gives you all different opportunities to try and find what resonates with you. I know a lot of people wanted to be short and going into this week or even last week, and that's cool. But just pick the place that's a higher probability to match for the underlying environment. A question on the XLU. I'll tell you what. When a lot of folks ask me, am I right now concerned about a larger pullback in the market? I'm not seeing flow that suggests it. Two places. One, where does the market, by and large, kind of hide out, right? Kind of hide for cover. And it would be in staples and utilities. It would be in things like your admirals and your dividend kings, right? Where do you go when you think the what is going to hit the fan? So I'm not seeing flow there. I'm not seeing people drive into those names while we're seeing flow out of tech, using that as the relative outperformer. I'm very interested, I think we talked about this yesterday, in the fade of the IWM. Super interested in that. But for the most part, when I look at something like XLU, I'm not super interested in XLU. And I think a lot of you know, it's not double green, Rog. Yeah, if right now you're saying to yourself, she's going to say it, Rog, it's not double green. And so while there are overbought and oversold fades at the top and bottom of the range, it would be valid. I'm not going to prioritize that over pullback buys within the context of the trend. And please, why am I always harping on the trend? So anyone who did well last year, whether you know it or not, whether you were a momentum trader or a dip buyer like me, everything you did, dollars to donuts, right? Everything you did, I bet, worked because of the uptrend. So whether you liked momentum breakouts, whether you like retracements, reversions to the mean, whatever you want to call it, all of that stuff worked better because the underlying environment, an uptrend, was really the ideal environment for it. So why not seek out and prioritize those environments where I would say most, not all, of course, but a large majority, the dominant majority, I'm talking 90% of folks who did well last year did well because of the uptrend, regardless of the strategy that they deployed. So why not seek that out? Which is why, sideways markets aren't typically going to be, my preference. Hey there, Dan. What's that sound? All right. Thank you, Dan. Yep. Thanks for smashing that like button. I appreciate that. Next up is Antonio asks, so Antonio, I was going back and forth about QQQ and SPY. And what we did ultimately in the Sector Secrets room is that we went with some specific, I'll show you right now what we did. I focused on things like XLV, relative outperformer, XLC, relative outperformer. And we actually put in a quirky little trade in gold because I like the zone that we're in. So we're long gold. So what I did, rather than go at the index level, why not go at the index level? Because when you crack open the indices, there is conflict amongst the sectors. There are certain sectors that are relative outperformers, and there's some that are still kind of wishy-washy. XLC versus XLY, right, would be a really good example within the NASDAQ. Within the S&P, XLV versus XLE. So they're weighted within that index, but they're not really rowing in the same direction. So I thought, why would I go with the broader index level? It's more expensive. So if you take a look at calls in the triple Qs or the SPY, you'll notice they ain't cheap. I like inexpensive options. That's one of the things that keeps us out of trouble, and it keeps our positions scalable. For example, I'll talk about a loser that I had, right? I'll talk about a loser that we recently had. I wanted to take a shot at a potential bounce in some oil stocks with the emphasis on the XOP. So we took a fade in MRO. I was wrong, but I was wrong in a 48 to 50 cents option. So scalable. I mean, I could buy 20 of these, $1,000 capital requirement, 25% risk. You see where I'm going with this? So if I'm going to take a shot at a sideways market, it better darn well be affordable, low risk, low cost. And low risk and low cost are much more, really very much a similar conversation than some people think about. When you get into a higher priced option, 20, 30, 40, 50, $90, your risk is a percentage of that cost, even if you've put on a vertical to offset the cost. And even if you put on a put credit spread, don't let the fact that you collected credit somehow trick you into thinking, well, I'm in a less risky trade. The option premium value is typically indicative of price and volatility. So, keep that in mind. I like low cost options, always have. I like to scale into them, right? So, if I can scale into GLD, for example, for $4.45, you think I'm buying a lot of them? I mean, for me, yes, I can buy 10 or 20 of them. I could buy 30 or 40 of them. It's very liquid ETF. But then other folks within the sector secrets can say, well, Rod, I can buy 2. Cool. Right now you've got 2 units of something. Your cost is under $1,000. Your risk is controllable, and it's going to be, again, scalable. So as you get better, maybe it's 2 contracts today, but it might be 22 a year from now. Who knows? And I love that scalability. And so I hope that makes sense. So what we did is we just reconsidered what's the relative outperformer within the NAS and what's going to be, a little bit more, low cost, right? So that's the way that we did that. All right. Okay. Gosh, that 20 minutes flew by here today. Sorry, I know sometimes I do such a deep dive on the individual questions, but I don't ever want this to sort of be just, taking on a question and giving you guys sort of an unremarkable answer that isn't something you can work with. But anyway, I think yesterday we had a nice sale day. We might with an inside day or even a minor low. I would welcome a little bit more weakness today. I would prefer that we don't make lower lows than yesterday, the Monday's session. But if we get some weakness, I'm fine with that. For those of you that are wondering, I'm done with crude, or I should say crude's done with me. I got to leave it alone for a minute, right? So we have to accept when certain markets, and I've been buying dips in crude since the beginning of the year. It's hard to let go. It is really hard to let go a market that has been so good to me, but it's broken the trend. Please don't make the mistake of saying, well, I just got stopped out. How do I get back in? Look elsewhere. In fact, anytime a market stops you out of a trade, put it on the do not trade list for at least a couple days. Otherwise, you are very susceptible. We would all be very susceptible to some revenge trading. All right, I'm going to be hopping into the options room and the futures room right now. I'll be dual broadcasting the first hour of the day. We're going to take a look at some day trading goodness here together. So I will see you all here for Charts and Coffee tomorrow. Thanks as always for being part of our caffeinated crew. Appreciate that. And I'll see you tomorrow. Be good to each other.